Hello everyone, you're very welcome back to the channel. Today we're going to be answering the question, should you buy a house in Ireland now or wait until 2024? To answer that question, we're going to look at housing affordability in Ireland. We're going to talk about the causal factors of housing unaffordability. We'll highlight the disparity between mortgage payments and rental payments in Ireland. We'll assess the probability of a housing market crash. And finally, we'll discuss what all of this means for first-time buyers, second and subsequent buyers, and buy-to-let buyers. What you're looking at here is the historical house price to income ratio, or HPI, in Ireland, the key measure of housing affordability. This graph explains the changing relationship between Irish house prices and Irish incomes over time. The basic premise is that the higher this line goes, the more unaffordable Irish housing becomes. As you can see, just before the end of the Celtic Tiger, Irish house prices were at peak unaffordability at a HPI ratio of nearly 6, meaning back then your average Irish house would be priced at just under 6 times your average Irish income. For context, the Demographia International Housing Affordability Study defines HPIs in excess of 5.1 as severely unaffordable. Between 4.1 and 5.0 is seriously unaffordable, 3.1 to 4.0 is moderately unaffordable, and under 3.0 is considered affordable. So there's no denying that the peak of the Celtic Tiger in 2007 was also the peak of house price unaffordability in Ireland. That peak was followed by a housing market downturn that lasted until 2013, sending the HPI in Ireland under 3.0, which made housing affordable by definition. But look at what happened next. Irish house prices grew rapidly relative to Irish incomes between 2013 and 2019, sending the HPI to around 4.5, or seriously unaffordable. This was briefly interrupted by the pandemic, but since then, the HPI has skyrocketed towards 5.0, which is where we find ourselves today. What has caused Irish house prices to become increasingly unaffordable since 2013, and specifically since 2021? Are there any lessons to be learned from the growth in Irish HPI between 1995 and 2007 that could explain the run-up in HPI over the past 10 years? More importantly, is the HPI in 2023 signaling a housing market crash similar to what was seen during the global financial crisis? Let's answer the questions around causation first, because if we don't understand why housing has become unaffordable, we can't make projections for the future. In November 2022, a research paper entitled Estimating the Trend of HPI in Ireland was published by Fang Yo from the Central Bank of Ireland. In this paper, Fang Yo finds that 79% of the variance in Ireland's HPI over time can be explained by changes in interest rates. 19% of the variance in the HPI can be explained by the availability of credit, i.e. the mortgage that an individual can obtain at any given time to purchase a property. Only 1.4% of the variance in the HPI is explained by imbalances between supply and demand in the housing market, i.e. the ratio of housing stock to the total number of individuals aged between 25 and 44. So over any given period of time, changes in the affordability of Irish housing can primarily be explained by changes in prevailing interest rates as set by the European Central Bank, and to a lesser extent, changes in the loan-to-income ratio as set by the Central Bank of Ireland. Fang Yo notes that between 1992 and 2021, natural interest rates fell from 8% to -2%. This is the main reason why housing affordability has worsened over the past 3 decades. As interest rates go down, so too does the cost of borrowing. If mortgages become cheaper, then naturally mortgage demand will increase. In the Celtic Tiger years, you had a falling interest rate environment and high mortgage demand. That demand was met with high mortgage availability, given that the banks had little to no standards for lending money, offering 100% mortgages in many cases. The combination of these two factors fueled the HPI to reach its severely unaffordable peak before everything came crashing down. If we look at the period between 2012 and 2021, which is 10 whole years, interest rates in the euro area were kept at 0, the cheapest time to borrow money in history, cheaper than the Celtic Tiger. So it's no surprise that during that period, Ireland's HPI rebounded to where it is today. During the same period, Ireland had, and arguably continues to have, inadequate policies for housing supply. According to the Banking and Payments Federation of Ireland, between 2011 and 2022, Ireland's population increased by over 500,000 people, while total housing output only grew by 130,000 units. So So the demand for housing that was ignited by low interest rates was not met with adequate supply. Whatever about the increase in housing unaffordability between 2013 and 2019, how about the increase in house prices post-pandemic? A 14% increase during 2021, and for much of 2022, an additional 10+% on top of that. In addition to rock bottom interest rates, these price increases were driven by record levels of household savings during the pandemic, which led to pent-up demand, and an additional strain on supply due to the shutdown of the construction industry. Although Irish incomes were growing during this time, albeit not always on a real basis thanks to inflation, they weren't growing as fast as house prices, which further extended the HPI. So that's how housing affordability has worsened in Ireland since 2013. Before we answer the question as to whether the HPI is suggesting an upcoming housing market crash, I briefly want to discuss the disparity between monthly mortgage repayments and monthly rental payments in Ireland. In a recent video talking about landlords and the Irish rental crisis, I mentioned that average rents in Ireland have increased by more than 82% over the past 12 years compared to the EU average of 18%. Brian Hayes, CEO of BPFI, notes that average monthly rental payments in Ireland are 40% higher than the average monthly mortgage payment for first-time buyers. That difference is even larger in Dublin and other major Irish cities. If you were a home buyer between 2012 and early 2022, you were locking in some of the best mortgage rates imaginable. Home ownership inherently protects you from the effects of rising rental prices. So while renters in Ireland were feeling the brunt of a shortage in housing supply, existing homeowners were feeling no such effect because their monthly payments change in line with interest rates, not supply and demand. However, the gap in monthly cost between buying and renting is starting to close. The European Central Bank raised interest rates on 4 separate occasions in 2022 and is continuing to do so in 2023. This is in response to Eurozone inflation, which reached multi-decade highs in 2022. As interest rates rise, so too does the cost of borrowing. Existing homeowners on variable rate mortgages and homeowners moving onto new fixed rate contracts have already started to see a rise in their monthly payments. Those looking to purchase a home now have to account for higher monthly mortgage repayments, which may impact their ability to qualify for a mortgage in the first place, especially in the context of higher all-round prices for goods and services in the economy because of inflation. In other words, as interest rates continue to rise, more and more prospective home buyers will be priced out of the market. With less individuals qualifying for mortgages, there's less of a demand for housing, meaning house prices could start to falter. We've already started to see the effects of higher interest rates. Despite mortgage drawdowns being at Celtic Tiger levels in 2022 as a whole, by the end of the year, a different picture was starting to form. Mortgage approvals in December were down 33% compared to November and down 5.7% year on year. House price growth slowed dramatically in the latter half of 2022, edging on monthly price declines. If the UK housing market is anything to go by, where prices have fallen for 5 consecutive months, things might just be getting started. That begs the question, is the Irish property market heading for a crash? Is the HPI telling us that history is about to repeat itself with a crash on the same scale as the global financial crisis? No, it's not. As was noted in Fang Yo's paper, at the peak of the Celtic Tiger, the HPI was 50% higher than the prevailing HPI trend. In the current market, the HPI isn't even 25% higher than the prevailing trend. In other words, house prices at the peak of the Celtic Tiger were much more overvalued relative to historical trends than house prices today, meaning a crash on the same scale just isn't feasible. What's more, the housing market in 2023 is very different to the Celtic Tiger housing market. During the Celtic Tiger, every Tom, Dick and Harry could get a mortgage, oftentimes for 100% of the value of the property. The reason why the Celtic Tiger HPI was 50% higher than the prevailing trend was because you had all of this borrowed money propping up house prices, creating a highly overvalued housing market. Things are different nowadays. Lending limits imposed by the central bank in 2015, i.e. the loan to value and loan to income ratios, have limited the amount of money that can be borrowed to buy residential property. Yes, as a first-time buyer, you can still get a mortgage for 90% of the value of the property, but the critical difference is that the loan to income ratio ensures that you can afford that mortgage, and the extent of your affordability will be stress tested by the banks for different interest rate environments. Put simply, mortgages post post-2015 have been of a much higher quality than mortgages that were granted during the Celtic Tiger. This limits the potential for an overvalued housing market due to excessive borrowing and further reduces the feasibility of a crash on the same scale as the global financial crisis. But that doesn't mean that house prices won't fall by some degree, and that brings us onto the main question of this video. Should you buy a house in Ireland now, or should you wait until 2024? Should you even consider buying in the next 5 years? It depends, and I know that's not the answer that people want to hear. You'd much rather a straight yes or no. The problem is that it's just not possible to perfectly time your entry into the housing market. There are too many unknowns. Plus, everyone has their own unique set of personal circumstances, so you can't say this is a time to buy or this is a time to hold off and expect that opinion to apply unanimously. However, here's how I'm looking at the housing market going forward. The biggest cause for concern is the ECB. Eurozone inflation is falling. Things aren't as bad as they were in 2022. However, the ECB is rightly continuing to increase interest rates, with a latest increase of 50 basis points on February 2nd, 2023. There are two questions to answer here. The first question is how much further the ECB will go with rates. The higher rates go, the more expensive it becomes to borrow. As the cost of borrowing increases, so too does the number of prospective home buyers being priced out of the market. Less buyers equals less demand, which will put downwards pressure on house prices. This downwards pressure on house prices won't necessarily translate into greater affordability because interest rates are higher. For example, let's say you want to purchase a home valued at €400,000 as a first-time buyer. You want to borrow the maximum 90%, and so you get a mortgage for €360,000 at an interest rate of 3% on a 30-year term. Your monthly mortgage repayment will be €1,509.93. Now let's say house prices fall by 10% because of rising interest rates. Same scenario as before, instead this time you only require a mortgage of €324,000 because house prices have fallen, but your interest rate is now 4%. Your monthly mortgage repayment will be €1,533.50. So even though prices have fallen by 10%, your monthly payment is actually €23.50 higher because the increase in interest rate offsets the benefit of the lower house price. The second question is how long rates will stay high for. If Fang Yo's findings are correct and 79% of the variance in Ireland's HPI over time is indeed explained by changes in interest rates, then a prolonged period of high and rising rates should reduce house prices and increase housing affordability, provided the benefit of lower prices exceeds the cost of higher rates. Regardless, it's unclear what the ECB stance on interest rate policy will be going forward. Their objective is a long-term average annual inflation rate of 2%, and they'll do whatever it takes to achieve that. We just don't know if higher rates relative to what we've seen since 2012 will be a permanent feature of ECB monetary policy going forward. The total opposite could happen. The ECB might get inflation to a satisfactory level before decreasing rates. That could result in a renewed demand for housing and an increase in house prices. With higher rates comes a greater risk of recession. The higher rates go, the greater that risk becomes. In 2022, the probability of an Irish recession seemed somewhat likely, but now that sentiment seems to have changed. But so long as the ECB is increasing rates, the risk of recession will loom. Higher unemployment is a key feature of a recession, and per Fang Yo's paper, higher unemployment is associated with an improvement in housing affordability. In other words, if a recession was to happen, we would expect Irish house prices to decline at a faster rate than Irish incomes. Then we have the issue of supply. Is the government going to be able to deliver on the Housing for All target of 33,000 new homes each year until 2030? How does higher short-term inflation and higher interest rates affect this goal? If supply targets are met, even amidst the higher interest rate environment, then we could see further downwards pressure on house prices. However, if the opposite is true and targets aren't met, then house prices could remain resilient. On top of all of that, you also have the central bank's decision to increase the loan-to-income limit for first-time buyers to 4 times gross income. There are two ways of looking at this decision. On the one hand, if you don't increase the LTI ratio over time, then eventually it will become too restrictive and it will price many home buyers out of the market. This is especially true when the HPI is rising and when there's a supply shortage like there is now. However, on the other hand, by increasing the LTI ratio, you're A, increasing the amount of borrowed money fueling house prices, and B, loosening the definition of what's affordable for the average borrower. Regardless, the central bank estimates that 8% will be added to Irish house prices over the next 3 years as a result of the decision. These are all of the factors that could influence house prices over the next 12 months, 3 years, 5 years, and even 10 years. This is why it's not possible to perfectly time the market. We just don't know what's going to happen. But here's what I'd say to each category of buyer. First-time buyers. The biggest question to answer is whether or not you need to buy a property right now. If property ownership is 100% necessary right now or in the very immediate future, and you can afford it even with higher interest rates, then you should likely go for it. Delaying your purchase in the hope of getting a slightly better price in the short term is a fruitless exercise, because as we mentioned, there are simply too many variables at play. House prices might decline, but interest rates might rise, resulting in a larger monthly repayment. House prices in your area could even continue to rise along with interest rates. That's before we even consider that you may live in this house for decades, and who knows what will happen to house prices over that time. I truly believe that if property ownership is 100% necessary to the progression of someone's life, be it starting a family or a new job, then you need to detach yourself from financial speculation. This boils down to asking yourself, why am I purchasing this property? Is it to make money or is it to progress my life? It can definitely be both, but for first-time buyers, it's normally more so the latter. If property ownership is not 100% necessary right now and you can afford to hold off a few years, I would recommend doing so. As I said, we don't know how interest rates and housing supply are going to impact house prices over the next few years. This is a very uncertain time for the housing market, and it might be more favorable to buy when some of those uncertainties become more clear. But again, that's speculation. However, interest rates are higher now than at any point in the past 10 years. On top of that, house prices are still classified as seriously unaffordable and supply is uncertain. So there's no arguing that the housing market is much less attractive for first-time buyers today than it has been for first-time buyers over the past decade. For second and subsequent buyers, you need to be very clear on your intentions. Are you someone who is approaching retirement and is looking to downsize? You might very well be sitting on a large unrealized capital gain from your current property that has only gotten larger over the past 2 years. In that case, realizing the gain now while house prices are still strong might be the best play, even if that means paying a slightly higher price than what could be obtained in the future for the property that you're downsizing to. For those looking to move home, perhaps to start or expand the family or for employment reasons, much of what I said to first-time buyers is equally applicable. If a significant mortgage is going to be required, then there's no denying that this is an unattractive time to buy. But if a move is 100% necessary and you can afford it, then you've already answered your own question. If it isn't 100% necessary, then you might want to wait until the uncertainties become clearer. Finally, for those looking to invest in the Irish property market as a buy-to-let opportunity, this isn't it. Better opportunities for total returns with much less stress exist elsewhere. If you're going to invest in Irish property at a time when prices have appreciated so much that the affordability classification is seriously unaffordable, you have to ask yourself, how much further can house prices go? How far can they go in the context of higher rates and increasing supply? As for net rental income after taxes, you have to consider whether you'll be earning a large enough profit to justify the additional workload associated with being a landlord. Will you even be left with a profit in the current interest rate environment, along with all of the other costs that eat into your net profit, not least of which is taxes? If you want to hear more about the current situation for landlords in Ireland, I have a full 20-minute video talking about this topic on my channel. So that's my take on the current state of the Irish housing market. I would love to hear your thoughts on the market as a whole and whether or not you're considering buying a home in the near future. Please feel free to share any anecdotes that you may have from your experience in the Irish housing market in the comment section. If you enjoyed this video, can I ask that you take just 2 seconds out of your day to show your support by leaving a like on the video and subscribing to the channel. Thanks very much for watching, and I'll see you soon.